Dear ECO 3311 students, yesterday was our last day of class. And as I mentioned in class, there was one chapter that was remaining with I needed to record and then send you a link so that you need to watch the video to be able to do your quiz number 7, which is the last assignment. And then chapter 16 is going to be part of your final exam next week. So make sure you watch this video. Once I'm done recording it, I posted the lecture slides, which are slide 16 is already, chapter 16 is already at Canvas. But because we didn't cover it, you need the recording for that lecture. That's why I'm recording this video. So anyway, I'm going to share my screen. Then we're going to start talking about that chapter 16. Let me just give me a second here. Okay, so there is your chapter 16. So the chapter 16 is our last chapter for this course, which is a conduct of monetary policy, strategy, and tactics. In chapter 15 that we wrapped up yesterday, we talked about monetary policy using geometry, using supply and demand. So we talked about the market for reserves, the demand for reserves, and the supply of reserves in the banking system. And then we also analyzed the tools of monetary policy using the supply and demand. So it was a very fascinating chapter. So here we are going to be continuing with that type of discussion, but we're going to look at how the tactics and the strategy that the Federal Reserve uses to control monetary policy, controlling the supply of dollars and interest rates in the economy. So here's a preview of this chapter. So this chapter is going to examine the goals of monetary policy and then considers one of the most important strategies for the conduct of monetary policy, which is inflation targeting. I'm also going to wrap it up by talking about some rule, which is called the Taylor Rule, named after a professor at Stanford, John Taylor. So here are the learning objectives. So we're going to define and recognize the importance of what we call a nominal anchor. And then we're going to identify the 6 potential goals that monetary policy makers may pursue. Like, what are the goals that the Federal Reserve wants to pursue? Or let's say the Bank of China, People's Bank of China, or the Bank of Canada. But we're going to talk about regarding to the Federal Reserve, the 6 main goals of monetary policy. And then we're also going to summarize the distinction between hierarchical and dual mandates of the Fed. So when the Federal Reserve was created in 1913, Congress gave the Fed some 2 mandates, like control, making sure that prices are stable in the economy, and the Fed should attain the goal of maximizing employment. And then we're also going to compare and contrast the advantages and disadvantages of inflation targeting, which is some new monetary policy framework which started in New Zealand in 1990, but then it soon spread to an increasing number of central banks in Europe, including the Bank of England, the Riksbank of Sweden, and even the European Central Bank. And even that framework also spread to emerging and developing countries like the Central Bank of Brazil, the Bank of Israel. They all target inflation. But the United States Central Bank, the Fed, has never adopted that framework yet. So the Fed has not explicitly agreed to start targeting inflation like the other central banks do. And then lastly, we're going to identify, the key changes made over time to the Federal Reserve monetary policy strategy. And then we're going to continue along with that discussion. We're going to list the 4 lessons learned from the global financial crisis of 2007, 2009, and discuss what they mean to inflation targeting. And we shall summarize the arguments for and against a central bank policy response to what we call asset price bubbles. And then we shall describe and assess the 4 criteria for choosing a policy instrument. I'm going to talk about what a policy instrument is. Then we shall interpret and assess the performance of the Taylor Rule as a hypothetical policy instrument for setting the federal funds rate. Okay, so let's kickstart stuff here. So all central banks, including the Federal Reserve, was founded on the premise that central banks must control inflation. So price stability is the overarching goal of the Federal Reserve System. The idea that the Fed must keep prices at some low and stable level, that means controlling inflation. So over the past few decades, policymakers, not only the Federal Reserve, but policymakers throughout the world have become increasingly aware of the social and economic cost of inflation and more concerned with maintaining a stable price level as a goal of economic policy. So the role of what we call a nominal anchor. So a nominal anchor is going to be defined as, it's going to be some nominal variable, such as inflation rate or the money supply, which ties down the price level to achieve the price stability. What do we mean by that? Because we know that from our previous discussion, the previous chapters earlier on in the semester, we talked about the role of money, how money can affect prices in the economy. Remember, we talked about the quantity equation, MV equals to PY. So the nominal anchor would be like the money supply level that can tie down the what? The level of prices in the economy to achieve the price stability goal. Okay. And then we're also going to talk about some concept called the time inconsistency problem in monetary policy. Okay. But before we talked about anything else, I already mentioned, in fact, I would put here to be zero. Start numbering from zero. There are 6 goals of monetary policy, but the main goal of monetary policy for any central bank, including the Fed, I already mentioned earlier in the previous slide, is price stability. So price stability is the main objective, or the main goal of monetary policy. But there are other goals that the Federal Reserve want to achieve. One of them include high employment and output stability. The goal of the Fed is to ensure that there's not a lot of unemployment in the economy. That means we're stabilizing GDP or output in the economy. Stabilization of output means you're going towards achieving the goal of what? Stabilizing employment, making sure that there's high enough employment in the economy that most Americans are not unemployed. If Americans are so much unemployment out there, the Federal Reserve is going to put in policy to make sure that we grow the economy and we create more jobs for the Americans. And such policies are things that you guys are probably aware already. It could include lowering interest rates. Okay, when the Fed wants to lower interest rates, they're going to buy bonds. They could lower the discount rate. They could lower the reserve requirement ratio using those tools of monetary policy that we discussed in chapter 15 and 14 to achieve that goal. The other goal is going to be economic growth. So the Fed wants to make sure that the economy is growing at a rate which can create jobs for the economy and maybe also make sure that there's stability in the price level. But the other goal that the Federal Reserve want to do is to stabilize the financial markets. We don't want financial market is critical to the what? To the health of the economy. The stock market and the bond market, and even the financial institutions. So there has to be some stability in the financial institution, like the nation's banks, private banks, because the Federal Reserve regulate all banking activities out there. But we're also going to ensure that our financial market, the stock market, the bond market, maybe the currency market, the market where we sell foreign currency, make sure that there's not a lot of volatility in those markets. So we need more stability. Then the Fed also, the other main goal of the Fed is to stabilize interest rate. We don't want interest rate which goes up and down so much, which is so volatile. So the goal of the Fed is to make sure that they smooth out any fluctuations in interest rate so that there's more stability. And then also stability in foreign exchange markets. So before I proceed here, those are numerous goals when you think about it. Those are 6 goals of the Federal Reserve. But remember, sometimes achieving one or two of those goals mean that there has to be some trade-off. You give up something. For example, let me give you one example. If, let's say, there's high inflation in the economy, prices are high, and the Fed wants to reduce that price. What does the Fed do to reduce inflation? The Fed is going to raise interest rates. But raising interest rate, while that can achieve the goal of lowering prices or attain the price stability goal and stable and low inflation in the economy, if the Fed can do that, but if they raise interest rate, that could be detrimental for economic growth, because interest rate is a cost of capital. So when they raise interest rate to achieve the price stability goal, that might actually end up causing unemployment. So the Fed may not be able to achieve high enough employment. So some of these goals of monetary policy are conflicting in a way that while the Fed may want to achieve one goal, it may end up making the other second goal worse. So there seems to be a trade-off between those achieving the various goals of monetary policy. So you got to. So the Federal Reserve has to walk a very tight line between what it wants to do, whether it wants to stabilize price. On the way you do to stabilize that price, you want to make sure that you don't overdo in such a way that you make the second problem even worse, like you cause more unemployment in the economy. Okay. So let me discuss briefly. There are two types of mandates. Okay. There's what we call hierarchical and dual mandates. Hierarchical is the idea that, because I already talked about this, we have these goals of monetary policy. It's like your shopping. Hierarchical is like you put these goals in an hierarchy, or in some, you kind of like in their order of importance, what the Fed view as the most important goal. For example, price stability is the most important goal that comes first. The Fed must meet that, then followed by high unemployment, economic growth, and so on and so forth. So if you list the goals of monetary policy, like 6 of them, and then you prioritize them based on their order of importance, then we call that the hierarchical mandate. Put the goal of price stability first, and then say that as long as it's achieved, other goals can be pursued. So price stability comes first. But dual mandates, when the Federal Reserve was created in 1913 through an act of Congress, Congress wanted to make sure that the Federal Reserve would achieve two equal goals, two primary goals that is very important to Congress, is price stability and maximum employment. So those became the dual mandates that Congress gave the Fed, that the Fed, even though the Fed may want to achieve 6 or 7 goals, but those two goals the Fed must address them with urgency. Okay. In fact, every year when the chair of the Federal Reserve testifies on Capitol Hill, the senators who interview them, who grill them during the testimonies, they don't typically cycle their testimonies around those two dual mandates, maximum employment and price stability, because those seem to be the main goal of monetary policy according to Congress. But price stability is always going to be viewed as the primary and long-run goal of monetary policy. But either type of mandate is acceptable as long as it operates to ensure that price stability is a primary goal in the long run, but not the short run. Then everything is fine. Okay, now let's talk about inflation targeting. So in the 90s, a group of central banks, starting with the Central Bank of New Zealand in 1990, they started to publicly announce their medium-term numerical targets on inflation. So what is that's what inflation targeting basically is the idea that a central bank must come publicly and announce to the public what they want to achieve on inflation. They might say, okay, we want to, the goal is to ensure that inflation is at its lowest point possible, maybe at 2% or 3%. Okay, remember, the goal of the central bank or the Federal Reserve is not to keep inflation at zero. No, because think about it. If inflation is zero, that means prices of goods are not changing at all. That's not good for the economy either. We want some little bit of inflation which is stable but low and stable inflation. In fact, the target for the Federal Reserve is always about 2%. They want inflation to be anchored at 2% range. So if inflation rises above 2%, let's say 3, 4, 5, 6%, then the Fed is going to act to bring inflation back to its target range of 2%. So inflation targeting is the idea that the central bank must come publicly and declare what their numerical target on inflation is going to be. As I say, the United States, the Federal Reserve does not pursue inflation targeting. Most of the countries in Europe are the ones pursuing this type of monetary policy. Inflation targeting also involves what they call some kind of institutional commitment to price stability as a primary long-run goal of monetary policy, okay, and the commitment to achieve the inflation goal. So it uses what we call an information inclusive approach, in which many variables are used in making decisions by the central bank. And also it has got increased transparency of the strategy. So according to the advocates for this new monetary policy framework, they think that because the central bank needs to come publicly and announce their numerical target on inflation and their commitment to inflation, they think that this brings some kind of transparency and accountability on the part of the central bank. compare that with what the Federal Reserve does, in between meetings, before the Fed meets, the Federal Reserve meets about 8 times to decide whether to change interest rates. But most Americans think that, in between meetings, the Fed kind of keeps the public in the dark. So there's some little bit of less transparency and, lower accountability. But the inflation targeting is the opposite. You make sure that the central bank is going to tell the public what they're going to do on inflation. So here's a little bit of history of inflation targeting. It started in New Zealand, of all places, in 1990. So inflation was very high in New Zealand in the late 80s and the early 90s. That's when this New Zealand central bank, the Reserve Bank of New Zealand, adopted inflation targeting. And inflation was brought down because the central bank in New Zealand committed its effort to fighting inflation as a primary goal of monetary policy. And then the growth has generally been high in New Zealand since then, and unemployment has come down significantly. Canada adopted the same inflation targeting framework in 1991. Inflation was problematic in Canada. It started then it decreased in 1991. Some costs in terms of unemployment was picked around along the way because, as I said, employment and price stability were both goals of monetary policy. But when you pursue one, that might be in conflict with the second one. So because when you think about it's like Canadian central bank might have tried to raise interest rates to bring inflation down, but if you over raise interest rate, that is detrimental to economic growth, can jeopardize output, and employment may go down. So you may experience high unemployment. That's what we saw a little bit in Canada. The United Kingdom adopted inflation target in 1992. Inflation has been close to its target. Growth has been strong, and unemployment has been decreasing since they adopted this framework. So here's kind of like a snapshot of what happened to inflation. So you can see this timeline where I put this vertical line, the green vertical line. Those are the times when those three countries adopted inflation targeting. You can see before, like the Reserve Bank of New Zealand adopted inflation targeting. But inflation was relatively high, but it came down significantly. But once they adopted it, inflation finally came down almost very close to hunkered around the 2% range. What about the Bank of Canada? Before the Canadian Central Bank adopted inflation target, inflation was rising in Canada. You can see that. And then once they adopted it, they committed to fighting inflation. Again, inflation came back to a very low level. Okay. The UK, maybe there's not a lot of evidence to suggest that inflation targeting actually helped curb inflation, because you can see for the UK case, inflation was already falling anyway. And, once they adopted inflation targeting, it came down somewhat to its lowest level. Okay. So let's talk about some of the advantages. What are the advantages of inflation targeting? This idea that the central bank must commit itself and announce to the public what their numerical targets are going to be on inflation, maybe over the medium and long term. The advantages that inflation targeting advocates normally populate out there. One of them is that inflation targeting reduces the potential of falling in what we call time inconsistency trap. Time inconsistency idea that if you allow the central bank to pursue policies using discretionary policy, like with their own discretion, the central bank will always have will keep changing policy from time to time, and that sometimes can destroy the policymakers' credibility. But if you're using inflation targeting, is a rule-based monetary policy. Rule-based basically means that the central bank follows a specific rules to control inflation. So you don't deviate from that rule. For example, if the goal is to allow money supply to grow at only 2% every year, you're going to follow a 2% money growth rule to be able to achieve the goal of low inflation in the medium term or in the long term. Okay. Discretionary policy, on the other hand, like what the Federal Reserve pursues, is like the Federal Reserve will change policy from time to time depending on what they feel is best for the economy at that time. But people who advocates for inflation targeting, which is a rule-based monetary policy, are going to argue that if you allow the central bank to change policy by their own discretion, when they keep changing those policies, when they say they're going to do something today, then they change their mind tomorrow, they're going to raise interest rate instead. That can destroy the credibility of the policymaker. And then the other advantage is that inflation targeting is most easily going to be understood by the public because the central bank publicly communicates with the what? With the public, letting them know what the numerical goal is on inflation, the target on inflation in the medium term, or maybe even going to the long term. And he also stresses transparency and accountability. It's also consistent with people the advocates for inflation targeting saying that because if a central bank comes and announces publicly, it means it's consistent with our democratic principles of more transparency and accountability. And it demonstrated some kind of improved performance. The disadvantage with inflation targeting is going to be one of them is going to be there's going to be some kind of delayed signaling. So if a central bank commits that they're going to reduce inflation by 2% in the next 2 years, when you implement an economic policy always typically affect the real economy with a lag. It's not like you're going to implement policy to fight inflation today and that policy will have an impact immediately. So because policies will affect real economy with some significant lags, there's going to be some kind of delayed signaling, and that can put the people who are running the central bank at risk that they may lose their jobs because if they don't achieve the target of inflation that they publicly announce, maybe they could get fired or something like that. And then there's too much rigidity. That's another disadvantage. The central bank overcommits to fighting inflation, and then sometimes it may forget that it has other goals to achieve, like maximum employment, the goal of economic growth, like financial market stability. So this is too rigid. The central bank becomes too rigid on fighting inflation, and then it might not do well on the other goals of policy. And there's also going to be potential for increased output fluctuations because anytime you commit to fighting inflation, you're going to lose on output because you're raising interest rates. That can cause volatility in the economy in terms of decreased output, decreased GDP, economic growth, okay? Low economic growth during the time when you're trying to disinflate. So what about the strategy of the Federal Reserve? As I said, the Federal Reserve never adopted the inflation targeting regime. When Ben Bernanke was the chair, I'll tell you a little bit of a story. Ben Bernanke was the chair of the Federal Reserve from 2006. Okay, he served in that role for 8 years. Okay, so you can count when up to like 20 I would say 2012 maybe, yes, 2014. Okay, from 2006 to 28 years, that brings 2014. But before he became the chair of the Fed, he was a strong advocate of inflation targeting, and many people thought that when Ben Bernanke became the chair of the Fed, he was going to steer the U.S. Federal Reserve policy to inflation targeting. But guess what? When he became chair, he never did. So the Federal Reserve pursues policy that we call it what? The evolution of federal. We want to talk about is going to be they use discretionary policy. But before I talked about the discretionary policy of the Federal Reserve, let's kind of talk about the evolution of the Federal Reserve's monetary policy over time. What has the Fed been focusing on in the past, and how have they changed that? How have they evolved over time? So, for example, let's put a little bit of history. The Federal Reserve began to announce publicly targets of money supply growth in 1975. So, from 1975 to around 1979, the Fed would say that we're going to allow the money supply to grow, like I say, 2%, 3%, anchored at 2%. Because if you put a target of how much you allow the dollar to grow, how much the rate at which you're printing the dollar, that is going to tie the price stability goal. That will tell you how much price level is going to be in the economy and inflation. So controlling money supply leads to controlling what? Controlling inflation or money or price level in the economy. But in 1979, when we got a new chair of the Federal Reserve, Paul Volcker focused more on the non-borrow reserves. We talked about non-borrow reserves in the previous chapter. Remember when we were talking about the market for reserves? When the central bank buys bonds, or sells bonds, it affects the non-borrow reserves in the banking system. And then in 1993, up to like today, Greenspan was a chair of the Federal Reserve from 1987 to 2006, the longest serving Federal Reserve chair. He served for 19 years. But in July 1993, under Alan Greenspan, the Federal Reserve would not use any monetary aggregate as a guide for conducting monetary policy. The Fed started targeting the federal funds rate, which we talked about the other day. So that started in 1993. Okay, so that's kind of a little snapshot of how different the policy has evolved in the United States over time. But when you look at the policy of the Fed, even though we're saying that the Fed was targeting money supply or targeting non-bond reserves, now they're targeting the federal funds rate. The Fed does not make any explicit nominal anchor in the form of an overriding concern for the Fed. There's no explicit nominal anchor. The Fed is not going to be like saying, okay, we're going to set this target or whatever. They don't publicly announce that. But the Fed pursues what we call their monetary policies based on what we call forward-looking behavior and periodic preemptive strikes. What do I mean by this? So the Federal Reserve does a lot of forecasts on the economy to predict what might come to inflation in America maybe in 3 years. They may already have some a good intelligent guess of how the position of the economy may say 2, 3, 4 years from now. So preemptive strike is the idea that if inflation the Fed is basically realizing that inflation might come down the road. The Fed may want to start putting policy to put the fire off before it gets started. What do I mean by that? Preemptive strike is the idea that when the Fed knows that inflation is coming in the near future, they are going to put in monetary policy to start fighting inflation before inflation gets started. Because from history, if you allow inflation to get started, and it start raging in the economy, it's very difficult to fight. Okay, so if the Fed is forecasting that inflation is going to come like in 2026, they might want to start putting policies today in 2025 to get rid of that inflation before it gets started. So that's what we call preemptive strikes. So the goal is to prevent inflation from getting started. The advantages of the Federal Reserve's policy strategy is that it uses many sources of information when it's conducting its forecast on inflation, and it has got demonstrated success. The Fed has been successful in controlling inflation in the history of the Federal Reserve System. But the critics of the Fed argue that the Federal Reserve does not communicate with the public enough. So there's some lack of accountability and lack of what? Transparency. And some of them argue that this is inconsistent with our democratic principles. Of course, there's going to be people who don't like how the Fed operates. They're going to label something bad against the Fed. That's exactly what they're talking about here. So the Federal Reserve's policy is best known. As I say, the Fed does not conduct what we call inflation targeting. The policy of the Fed is what we just call the Fed's just do it approach. Another way of saying it is calling what? The Fed implements monetary policy by what? Policy by discretion. So they implement policy by discretion. Discretion is the idea that the Fed is going to change its policy from time to time based on what they feel is best for the economy at that time. That's so they have all the discretionary powers to do that. So in other words, politicians are not going to set any rules for the Federal Reserve to follow. The Federal Reserve exercises its discretionary policy over interest rates and over money supply. Congress, even though Congress wrote the Federal Reserve Act that created the Fed in the first place, the Federal Reserve has to be as independent as it can possibly be from the other branches of government, from the executive branch, the judiciary, and the legislature. So the advantages of the Federal Reserve's just do it approach, or the Federal Reserve's discretionary approach, is that the Fed has a forward-looking behavior and a stress on price stability, also help to discourage overly expansionary monetary policy, thereby ameliorating the time inconsistency problem. So the Fed is going to have this forward-looking behavior. But the disadvantage, I already talked about the disadvantage, is that some people who don't like what the Fed does, discretionary policy, they're going to say the Fed lacks transparency, there's strong dependence on preferences, skills, and trustworthiness of the few elites, highly trained economists and finance experts who work for the Federal Reserve System, especially members of the Federal Open Market Committee, this 12-member body, including the 7 board of governors and the 5 presidents of the regional branches of the Fed, who meet about 8 times in a year to decide, the fate on interest rates. So some Americans have issues with that. They think that is basically centralizing power in the hands of very few individuals. They think this is inconsistent with our democratic norms, because when the Fed changes interest rate policy, interest rate affect the lives of will influence the livelihood of all Americans. We over 320 20 million Americans here. So they think that by us leaving monetary policy in the hands of very few individuals who are highly trained, that is not consistent with our democratic norms. But that is basically a critique or a limitation or a disadvantage that people view the federal policy to be. So I kind of reiterated the same thing here, same thing. So when Ben Bernanke, as I told you, when Ben Bernanke was the chair of the Federal Reserve, he was the governor of the Federal Reserve. He was a professor at Princeton University, a professor of economics. He took his position as a governor of the Federal Reserve from 2002 to 2005 before he assumed the full role as a chair of the Federal Reserve in 2006. So when Ben Bernanke was the governor of the Fed, he was a strong advocate of inflation targeting. To an extent that when he became chair in 2006, a lot of people, economists and policymakers around the country thought Ben Bernanke was going to steer policy to inflation targeting. But guess what? As I said earlier, once Ben Bernanke became chair of the Fed, he continued with the Federal Reserve discretionary policy approach to controlling inflation or in controlling interest rates and money supply. Okay. So what about the European Central Bank's monetary policy strategy? So European Central Bank has also been slow to move toward inflation targeting. They have adopted some kind of a hybrid monetary strategy that includes some elements of inflation targeting, but it's not a full-blown inflation targeting. So now, having said that, I want to jump into something that is very interesting. I know a lot of you, when the financial crisis hit in 2007, 2009, many of you were you told me in class that you were in second, third grade, fourth grade, you were quite young, you probably don't remember what happened. Okay, so here's what economists, the long-established position among many economists, especially macroeconomists, about the relationship between finance and the broad economy. One thing that economists had long believed in was that developments in the financial sector have the economists believe that if something were to happen, a major shock in the financial sector, like on Wall Street, like banks, that would not have far-reaching implication to the broad economy. It would not affect the real economy that much. But economists were proved wrong because in 2007, 2009 financial crisis that started in the housing market, that financial crisis actually eventually led to the Great American Recession. That led to output really falling significant, and many Americans lost their jobs. So we learned our lesson that actually something that we never believed in the past, that developments in financial sector indeed has a far greater impact on economic activity than we earlier thought. And then the other lesson that we learned the hard way as economists, especially macroeconomists, is the idea of the zero lower bound on interest rates. It can be a serious problem. Okay, so when the financial crisis hit in 2007, I mentioned this in my class, I think even yesterday, interest rates in America were almost near zero. They were very low. Because the whole idea is that when the economy goes to a recession, the Federal Reserve uses policy to reduce interest rate to grow the economy out of a recession. But the problem was that for the Federal Reserve to reduce interest rate, you need to have high enough interest rate, enough wiggle room on interest rate for the Fed to actually have room to reduce that interest rate. If interest rates are already near zero and the economy experiences a recession, the question is, how low can the Fed lower interest rate? Do you want to lower to make it negative? That was a big challenge, because we saw that with the experience of the Japanese of the late 90s, sorry, of the entire 90s. We call it the Japanese lost decade of the 90s. So the Japanese economy experienced a serious inflation. Then the Bank of Japan lowered interest rate so much that interest rates actually became negative in Japan. So when interest rates became negative, this is the idea that you would walk in a bank in Tokyo and borrow 10,000 yen, and then you pay back 9,000. You think any bank is going to lend you those funds? So banks in Japan say, no, thanks. And they refuse to lend funds. So the Japanese economy did not have any economic growth for the last decade of the 90s. That's why when you hear politicians or economists talking about the Japanese lost decade of the 90s, they're referring to that scenario where interest rates in Japan became negative, and that led to slower economic growth, or no growth at all in Japan for 10 years. So the economy of Japan stagnated. So we already learned from that history. So when the financial crisis hit in 2007, and interest rates in America were already close to their zero lower bound level, they were close to zero. The Federal Reserve would not make that mistake to lower interest rate to negative to basically trying to make the economy strong, because you lower the interest rate to make it negative. That's what we call the liquidity trap. That brings even more problems than you're trying to solve. Okay, so that turned out to be that means the Federal Reserve had a very challenging time in 2007. That means conventional monetary policy that always aimed at lowering interest rate during crisis time, during recessionary times. The Federal Reserve could not pursue those conventional monetary policy tools. So they forced Ben Bernanke, who was the chair of the Fed, to come up with some unconventional tools, out of the box policy, things that were never tried before. And I discussed some of those in my class in the chapter 15. Like quantitative easing, which is basically this large asset purchase from Wall Street, to shore up liquidity in American banking, in 2007 to 2009. And then what we also learned was that the cost of cleaning up after a financial crisis can be really high. That's something we never thought about. I even shared with you in chapter 5. I told you that the Federal Reserve spent nearly $4 trillion to bail out the economy. And then Congress was also spending money, money that the Congress passed to bail out the economy. So fiscal policy was also being used to stimulate the economy. So the cost of cleaning up of the financial crisis can be really huge, can be big. And then the last lesson that we learned as economy was that price and output stability do not guarantee financial stability. That is true. In fact, when you look at the episode that created the 2007-2009 financial crisis, right before the financial crisis actually started, the economy was very stable. GDP was stable, inflation was stable at its lowest level possible. And then all of a sudden, the financial crisis just sparked from somewhere. So the lesson we learn as economists is that even though the goal of monetary policy is to stabilize output and prices, if you don't, problems in the financial services industry can actually prop up from anywhere. So that means it calls into question of the broader issues of regulation. You may have a very stable economy, but if you're not regulating the activities of banks on Wall Street and then they screw up like they did in 2007, you could still end up with a serious financial crisis. So output and price stability do not guarantee financial stability. That's a hard lesson we learn as economists. Okay. So here's some implication for, so I already talked about implication, you talk about inflation targeting. We can skip that. Okay. So now what I want to talk about, which you guys watch in the video when we talked about the video of the financial crisis, should central banks respond to what we call bubbles? First of all, what are bubbles? Bubbles are basically the idea that the values of the value. Let me write in a little bit here. Let me open this new slide here. So bear with me for a second. Okay. Okay, so let's talk about a bubble. So a bubble is basically when asset prices change, or we can say maybe they increase, okay, unrealistically, in a way that does not reflect their true fundamental value. That's what a bubble is. Okay. So we saw something in the early 2000s, when you're watching a video, the housing market, for example, because housing is an asset, real estate. So the housing market experienced a bubble in the early 2000s that the prices of American homes were rising almost practically forever. and you buy a house in 2002, then you would see, the price going up $10,000, $20,000, $50,000 in a very short period of time. So when you look at the actual increase in the value of the house, it doesn't really reflect their true fundamental value. But the problem with a bubble is when a bubble is occurring, sometimes it's very difficult to, let's say you buy a house and your house goes up by 30% in value. If that house is experiencing a bubble, then sometimes it's very difficult to separate what is the true value increase in the price of the house and what part is being driven by what we're calling a bubble, the unrealistic aspect of it. Okay, it's very difficult sometimes to separate in the data. So there are two main causes of bubbles. Two causes of bubbles. Okay, the first one, which is the most common, is a credit-driven bubble. Credit-driven bubbles. So this is the idea that banks start to significant increase lending to an industry like housing, the housing industry. So if the banks start to make borrowing money easy, cheap for Americans to borrow money, lowering interest rate, let's say the interest rates are very low and banks do not even have like very strong verification process when they approve people for loans, that can create a bubble, because then most Americans who may not, some Americans who may not even are not supposed to be buying those expensive homes, find themselves buying those homes because there's laxity in verification of people's credit, their income, sources of income, and stuff like that. That can create a bubble that, because if you make so many people buy homes, that's going to drive up the demand for housing, and that leads to an increase in its price. So that's one cause of a bubble. The other second cause of a bubble is what we call irrational exuberance of the investors. Okay. So this continue with this discussion here. So the second cause of a bubble is what we call irrational exuberance of investors in an industry. What do we mean by that? This is when investors develop some wild, unexpected view about the future value I'll say while unexpected, not unexpected, while unrealistic, that's what I mean to say, while unrealistic view about the future value of an asset. For example, we see that from time to time, like even in the stock market, whereas people go to Robinhood and they start chit-chatting. Robinhood, Reddit, and then we saw that with like AMG, I don't know, not AMG, there's what is that stock? GameStop. They had their stock prices rise like crazy because of this wild investor expectation about the future value of that asset. It can happen in any industry. That's the same thing that can happen to housing. If Americans are start to have like this wild, unrealistic expectation about future increase in the prices, in the value of houses, then people will start to buy a house at a rapid rate because they want to make a profit. Somebody buys it not because they want to live in it, but because they want to short that house in 2 years and make a profit. So that can create a bubble. If every one of us had to act that way, that this wild and unrealistic expectation about future increases in the value of an asset, it can cause the what? The value of the asset to go up anyway. So that's what I talked about here. So pronounced increase in asset price that depart from fundamental values, which eventually bust. Types of asset, I tell you what, the credit-driven bubbles. We saw that a lot during what? Financial crisis. And then I don't know why I put it. This would be a dot. These are two causes of bubbles: credit-driven bubbles and bubbles driven by rational exuberance, which I already explained. So the question is, should central banks respond to bubbles? So there's what they call the Alan Greenspan doctrine, that monetary policy should not be used to prick bubbles. That's Alan Greenspan when he was the chair of the Fed. The Federal Reserve should not be there to lower interest rate that can cause market to what? To go wild with what? With borrowing money. So asset price bubbles are nearly impossible to identify. Okay? Raising interest rates may be very ineffective in limiting bubbles because market participants expect such high rates of return from buying bubble-driven assets. And monetary policy actions are a blunt instrument and likely to affect asset price in general rather than the specific assets that are experiencing a bubble. So monetary policy actions to prick bubbles can have harmful effects on the aggregate economy. Timely monetary policy can help the harmful effects of a buzz. So these are some of the Alan Greenspan doctrine when he was the chair of the Federal Reserve. Okay, so should central banks respond to bubbles? That's a question of our time. Some people depart from the Allen doctrine and say yes, the central bank should respond to. The problem with bubble is, as I say, sometimes it's very difficult to identify when an asset price goes up 40%, you don't know what is real and what is unreal. That's why Alan Greenspan is basically emphasizing that we should not respond to bubbles because first of all, we don't know how to identify it in the first place in the data. Okay, when the housing price goes up 30%, we don't know we can't concretely say how much of that 30% is a realistic increase in the value of an asset that actually reflects its true fundamental value, and which portion of it reflects a bubble. So since we can't identify precisely a bubble from an increase in the value of an asset, we should not be able to stop it because we may end up harming the economy in general or hurting the industry that we are trying to control. And then there's what we call macroprudential policy. Macroprudential policies, these are regulatory policies that will affect what is happening in credit markets at the aggregate level. For example, if the Federal Reserve comes up with a policy that all banks in America should use to control credit, or some kind of credit rationing or something like that, then it becomes a macroprudential policy because it affects the economy at the aggregate level. So monetary policy, and then so the other thing that the people who depart from the Allen doctrines always argue that central banks and other regulators should not have a laissez-faire attitude and let credit-driven bubbles proceed without any reaction. So if we can identify that the bubble is being caused by banks being reckless with lending in an industry, maybe the central bank can go and rein on these banks and put more regulations out there to prevent over excessive lending of funds that can prick or cause that bubble to begin in the first place. Okay. So now let's go to the holy grail of things here. Let's talk about so here's where I want you to pay much attention. What we call the choosing of the policy instrument. The tactics that the central bank or monetary policy will pursue to achieve the broad goals of monetary policy. So there are two things that I want you to understand here. We talked about tools of monetary policy already, okay? Which you could add another one here, which is what the one that the Fed started pursuing in September 2008, which is paying interest rates on what? Interest rate on reserves. So particularly these three tools of monetary policy is what the Fed has always used ever since the Fed was created in 1913. So let's say, for example, the economy went to a recession where the Fed needed to grow the economy out of a recession. The Fed could pursue open market operation. They could buy bonds, okay? They could lower the reserve requirement ratio, make it easier for banks to loan funds out of customers' deposits. They could lower the discount rate, which is this interest rate that the Federal Reserve charges bank when it lends money to banks, make it easier for banks to accept discount loans, because that's how money supply goes up, interest rate goes down, then you grow the economy. The Fed knew if this inflation is a problem, then they would do the opposite. If it's inflation, the Fed is going to raise interest rate by selling bonds. Okay, they are going to increase the reserve requirement ratio. They are going to increase the discount rate, make it harder for banks all across America to what? To access discount loans from the Federal Reserve. And then there's what we call the policy instrument or the operating instrument. So anytime you change the tools of monetary policy, I'm going to show you shortly here. You change the tools of monetary policy. For example, you buy bonds. Buying bonds is going to affect the policy instrument. It's going to affect the reserve aggregates. When I say reserve aggregates, these are going to be things like non-borrowed reserves. It's going to be affected when the Fed buys or sells bonds. It's going to affect the interest rate, which is going to be the what? Like the federal funds rate. Okay. And then that is going to be linked to some kind of intermediate target. So let me show you. So there's what we call the monetary transmission mechanism. Okay, so I want you to understand this picture very well. I'm gonna try my best to explain this. Okay, so here are the broad tools of monetary policy that we talked about. The main one are the first three conventional tools of monetary policy. So, and then these are the goals of monetary policy. The goals of the monetary policy, we talked about them. They include things like price stability, high employment, economic growth, financial market stability, interest rate stability, foreign exchange market stability, like stabilizing the value of the dollar. Okay, so let's pretend that for some reason, some of those goals are not being met. Something happened in the economy. Instead of us having high unemployment, we have the opposite. They say there's high what? Instead of having high employment, we end up with high unemployment or low employment. So the Fed needs to act. That means, so if the economy slows down in a recession and we end up with a what? High unemployment, the Fed is going to reach out. It's just like you. That means there's a problem in the economy. It's like saying if a chain comes out of your bike, you reach out for your most favorite tools in your toolkit to fix that chain from in your bike so you can ride your bike again. That's the same thing with the Fed. If something goes wrong with the goals, with the economy, like there's high unemployment instead of high employment, then the Fed needs to reach for its most favorite tools here to fix the economy. And one of the most important tools that the Fed uses most of the time is the open market operation, which is buying and selling of treasury bonds. Okay, it's like your most favorite tool, like a plier, which it might be in your toolbox. Okay, a plier, we use a plier for solving so many problems in a house. Okay, so one could argue that the Federal Reserve's plier is an open market operation. That's a tool that they use about 96% of the time to fix the economy. Okay, so now let's say there's high unemployment. So the goal of the Fed is to lower interest rate because the economy is in a recession. Lower interest rate means the Fed needs to buy bonds. Okay, so in this case, the open market operation here, if the Fed is to solve high unemployment problem, they need to purchase what? Buy securities. Okay, and you guys are already smart enough. We talked about this in the previous chapter. So we're saying that, think about it. So let's say the Fed wants to stimulate the economy so that they create more jobs again by buying $100 billion worth of treasury bonds from banks. So you know how to illustrate this already. So let's say, suppose the Fed buys $100 billion. So you already know from chapter 14 that you know how to illustrate this. They're buying this from banks. So this is going to be the balance sheet, the T account of the banks and the T account of the Fed. So when the Fed buys securities, excuse my handwriting, they look like chicken feet here. I hope you'll be able to see. So when the Fed buys $100 billion, when you buy something, you gain it. That means the securities of the Fed is going to go up $100 billion. But the banks are the ones selling. You know, this is the left-hand side is your assets. Right-hand side is your liability. This is assets, liability on the right. You know that. So the banks are ones selling their securities to the Fed. In this case, when they sell them, you lose it. So then negative, we debit the bank's asset by $100 billion. But the Fed, all banks in America, when the Fed buys something from banks all across America, buy their security. How does the Fed pay for it? All banks already have an account with the Fed called the reserve account. So reserves are bank assets. So the Fed is just going to credit the bank reserve account by the actual amount of the purchase. We have done this over and over. So while reserves are the bank's assets, they're actually the Federal Reserve's liability. They're the monetary liability of the Fed. So reserves here are going to go up $100 billion. And then we know, so you know that change in reserves, and particularly what change here is what we call non-borrow reserves. This NBR is what? It stands for non, because the Fed is not what? Loaning money to banks. It's actually buying what? Securities. So the reserves that get affected is non-borrow reserves. That has gone up by $100 billion based on this balance sheet. And then you also know that the change in the monetary base, we've seen this already, must equal to little m, the money multiplier, times the change in the money supply. I'm sorry. The monetary base equals to currency plus reserves. You know this. So the change in the monetary base is going to be equals to change in currency plus change in reserves. Since reserve was changed by $100 billion, we're assuming currency has not changed. That means the monetary base also goes up $100 billion. See that? So now, but that's not the end of our story. The end of our story is going to be, so what? Once monetary base and reserves have gone up by $100 billion when the Fed buys bonds, then what happened to money supply? Then in chapter 14, we derive the money multiplier, the full model for money creation process. So there's a connection between money supply and the monetary base. We say that the money supply, M, is equals to little m, which is the money multiplier times the monetary base. So that means the change in the money supply equals to little m times the change in what? The monetary base. Okay? So if the money multiplier, well, let's say this was 2. Let's say the size of the money multiplier is 2. That means when the Fed buys bond, the money supply is going to expand by what? It's going to expand by 2 times, remember the monetary base changed by $100 billion. So this potentially can raise the money supply by what? $200 billion. Okay, so you know you're following. And then in chapter 4, we can look at the money market. That's the market interest rate is going to be affected. Interest rate, and here you have your what? Quantity of money. So if this is your initial money supply, M1 prime, this is your money demand, MD. This was your initial interest rate. When the Fed buys bonds, we know that that's going to lead to a what? That's going to lead to an increase in what money supply shifts to the right to some level M2. So then the new equilibrium is going to be here. So interest rate is going to fall. So this interest rate that we're talking about in the money market, that's what we call the market interest rate. Okay. But we also seen in chapter 15 what happens to the federal funds rate. Okay, when the Fed buys bonds. So using the graph, I showed you already this very clearly in chapter 15. Again, if you skip class, then I'm very sorry for you because it's too late. That might be very difficult for you to understand these things. So we talked about the market for reserves in chapter 15, which we are measuring interest rate here. So the demand for reserves in the banking system was given by that. And the flat is a king demand curve. It's downward slope and then becomes flat. The flat portion of the demand curve determines the interest rate on what? On reserves. Then the supply curve for reserve is what? Is upward slope, is vertical. So I can't even barely draw my line here. I'm bad at using digital pen. So that is your supply curve. The upper portion of the supply curve is a discount rate. So this equilibrium is what we're calling the federal funds rate. Equilibrium, let's say it's target 1. So this line here, this vertical line determines what we're calling the what? The non-borrow reserves in the banking system. So when the Fed buys bonds, we have seen that reserves go up. So it shifts the non-borrow reserves to the right. We saw this already. So now only the vertical portion shifts to the right, to NBR2. Shifts this way. So the equilibrium in the market for reserve is going to happen where the new supply curve, this line here, plus this flat portion, intersect the demand curve, which is this point. So that's going to lead to a decrease in the what? In the federal funds rate. Okay, so you always hear that the Fed has lowered interest rate. The interest rate that the Fed lowers is not your market interest rate. It's not your student loan. It's not your car loan. It's not the interest rate on your what? On your mortgage. No. So, but if the Fed lowers that interest rate, because it's buying bonds, it's injecting liquidity in the banking system, money supply goes up, then the market interest rate, which I talked about here, is going to be affected. So we can understand that using this monetary transmission mechanism. When the Fed buys bonds here, okay, open market operation, that is going to lead to what? Non-borrow reserve is going to change. Like I say there, see? Non-borrow reserve is going to go up. So the non-borrow reserve, and then the federal funds rate is going to fall. So non-borrow reserves or federal funds rate is what we call the policy instrument. Okay, so those are the policy instruments. So we reserve aggregates like non-borrow reserves, okay, short-term interest rate at the federal funds rate. See, those are the policy instruments. So once the federal funds rate decreases and non-borrow reserves go up, that is going to lead to, it's going to affect the intermediate targets. Intermediate targets are going to be things like money supply, the market interest rate, So this interest rate you're seeing here is no longer that's now the market interest rate, like the interest rate on your mortgage or the interest rate on a car loan, interest rate on on your student loan. Okay, and the way those interest rates get affected is what I already demonstrated here. You see, once the Fed buys bonds, monetary-based non-borrow reserves change, and then money supply is going to go up. So the market interest rate is just going to fall. So the market interest rate is going to fall in the same. So you could literally think of the federal funds rate, the interest rate that the Fed controls. When you say the Fed has lowered the federal funds rate, that interest rate acts as a signal to the market that all other market interest rates need to fall. And that's what, because money supply gets expanded in the process. So that's what so now once the short-term interest rate is affected, like market interest rate, like your mortgage rates or your student loan rate, then that's going to affect the broader goals of the economy. Because remember, in your baby economics class, you know that GDP is a sum of consumer spending. You remember this equation for GDP: investment spending, government spending, and net exports. So once the Fed has lowered the market interest rate, then investment is going to go up, because investment depends on interest rate. Businesses are going to find it easier to invest more when interest rates are low, market interest rates. The cost of capital has gone down. Consumers are going to find it easier to borrow money for consumption, like credit cards or consumer loans, when interest rates are low. And government might also find it easier to borrow by issuing debt when interest rates are low. But also all these are components of GDP. So GDP is going to go up. And once GDP goes up, that is how we fight unemployment. Okay? So what I've described here, how changes in the tools of monetary policy, like the Fed buying bonds, leads to what? The changes in the policy instruments, and policy instruments lead to changes in intermediate targets. Intermediate targets are things like money supply, market interest rate, like interest rate on your mortgage or your student loan, and how that, when that change, how that then affect the broader real economy, like employment, price level in economy. That is what we call the monetary transmission mechanism. Monetary transmission mechanism. Some textbooks call it propagation mechanism. Monetary transmission mechanism is basically the idea that how changes in the tools of monetary policy by the Federal Reserve, like buying or selling bonds, will affect the policy instrument, and the policy instrument ends up affecting the what? The intermediate targets, and intermediate targets end up affecting the broader goal of monetary policy, like the real economy. Okay, so if inflation was a problem, let's say, remember, one goal of the Federal Reserve was price stability. What about if prices start to rise to a level that the Fed doesn't like it? Inflation started to get out of hand. What did we see the Fed do like 2 summers ago when inflation, post-COVID inflation, creep into America? The Fed raised interest rates. How does the Fed raise interest rate? They're going to pull the trigger from here. They're going to sell bonds, an open market sale of treasury securities to banks. When they sell bonds, the opposite of what I described is going to be true. So again, you go back to what we did here. When they're selling bonds, When the Fed is one selling, that these gains are going to be, you change the signs because it's selling bonds, meaning that reserves in the banking system is going to be go up. The banks are going to be buying. This becomes plus. So this becomes negative. Reserves fall. Monetary base is going to become negative. Money supply is going to fall. Then interest rates are going to fall in the economy. So they're going to go up in the economy, not fall. Interest rates fall when monetary base is what? Is decreasing. Money supply is going to fall. So in the money market here, when the Fed sells bond, the money supply is going to shift to the left. So interest rate rise in the economy because the Fed wants to raise interest rates to slow down the economy from having excess inflation. Okay. All right. So one thing that is for sure, the Federal Reserve, okay, we know that the Fed, any central bank has to choose among these policy instruments what they want to target. As I said before, from 1979 to 1993, the Federal Reserve under what that is, 1993, they were targeting what they call non-borrower reserves, and during Paul Volcker era. Okay, but then from 1993, when Alan Greenspan was the chair of the Federal Reserve, the Fed switched from targeting non-borrower reserves to targeting the federal funds rate. See, this federal funds rate, that's what we say, that's now the policy instrument of the Fed. But what is for sure, I want to make some very stark in policy here, that the federal, a central bank like the Fed, so a central bank like the Fed cannot have more than one instrument, one operating instrument, one operating policy instrument. It's not feasible. Practically, it's not feasible. In other words, the Federal Reserve cannot choose to target the federal funds rate and also target the what? Set a target on non-borrow reserves. It's not possible. If you choose to target the non-borrow reserves like we used to do from 1979 through 1973, sorry, 1993, then you allow fluctuation. You're not going to be able to target the federal funds rate. If you choose to target the federal funds rate, you're not going to be able to target the non-borrow reserves. That means you allow fluctuations in the what? The non-borrow reserves. Let me give you an example here. So this was a policy of the Federal Reserve from 19 policy. The Fed used to have what? We used to target what? The non-borrow reserves from 1979 to 1993. Policy was to target the what? Now, so think about it. So if the Fed has set a target on non-borrow reserves, let's say this was the initial intersection between supply for reserves in the banking, the blue lines, where the blue lines intersect. So the initial federal funds rate, equilibrium federal funds rate, is this guy here. So now, if the Fed has made a choice to target the non-borrow reserve, let's say banks decide to start increasing their demand for reserves. If banks, that's something that the Fed cannot stop. So if the banks increase the demand for reserves, you see, the demand for reserves is going to shift to the right. Only the downward sloping portion shift, remember? So that is going to raise the federal funds rate. But when you reach this point here, the new equilibrium here, where the dashed line intersect the solid blue line, the Fed would allow the interest rate to go up as long as the target on the non-borrow reserve is not affected. So in other words, there's no way the Fed is going to target the non-borrow reserves and then also let interest rate be at IFF, the blue one. No, it's not possible. You cannot have it both ways. If you choose to target the non-borrow reserves, you're going to allow fluctuations in the federal funds rate. And then from 1993, okay, I talk about this earlier on in a little history. And then, so from 1993 to today, the Fed targets what? The federal funds rate, IFF. Okay, that's why we always see, the Fed has raised interest rate, has decreased interest rate. They set a target on the what? On the federal funds rate. But if the Fed chooses to target the federal funds rate, Let's say they set a target of 2%. The Fed is going to do anything possible to make sure that that interest rate stays at 2%. Okay, for example, let's say the initial equilibrium is when the blue line intersects, that determines that target. So let's say banks start to increase their demand for reserves, they're shifting the demand curve to the right. Potentially, interest rates should rise to this level. But remember, the Fed doesn't want interest rate to go up because they set a target of 2%. So the Fed is going to counter that through what we call a defensive open market purchase of what? Of treasury securities. They're going to buy bonds to increase the non-borrow reserves will shift to the right by just enough so that the two dash lines meet here. That's going to be the new equilibrium, where the new supply curve intersect what? The new demand curve. So that would keep the interest rate at this target. But by doing so, the Fed is going to allow what? The non-borrow reserves to fluctuate. So there's no way the Fed is going to maintain non-borrow reserves at the blue one and also maintain targeting the IFF. It's not feasible. If you choose to target one, you are going to let the other ones fluctuate. So that is always the reality that, or the challenge that every central bank faces. A central bank cannot target more than one operating instrument. It's practically not feasible. I want to reiterate that. If it chooses to target the federal funds rate, then it will allow fluctuations in non-borrow reserves. If it chooses to target the non-borrow reserves like we used to do between 1979 and 1993, then you're going to allow fluctuation in the federal funds rate. Okay? But you can't have it both ways. Okay. So what are the criteria for choosing the policy instrument? Like, why would the Fed want to choose like the federal funds rate as its policy instrument that it targets? These are the criteria. The choice of the policy instrument depends on its observability and measurability. You want a policy instrument where the central bank can easily observe and it can easily measure. Interest rates is easier to measure. We can know how interest rates go up, go down. We can measure them. And then you want to choose a policy instrument where you can have full control. The Fed has a lot of control over the federal funds rate. Okay? They will sell or buy bonds if they want to achieve a target on the federal funds rate. So they can control it. You don't want a policy instrument where you cannot control. Predictable effect on goals. Okay? So what do I mean by this? You want a policy instrument where if let's say the Fed has changed, they want to raise interest rate by 1 percentage point. They already know what the predictive impact of that raising interest rate is on GDP, on employment, on price level in the economy, and inflation. They can easily predict what a 1% increase in interest rate is going to bring to those other economic variables that we care about. So you want a policy instrument where you can easily predict its effect on the broader goals of monetary policy, the goals on price stability, employment, and stuff like that. So those are the three criteria. Okay, so now I want you to pay much attention here. The last thing I'm going to talk about here is the Taylor rule. Okay, so the Taylor rule, let me talk about it here. I'm going to open some new slide here and then talk about it. The Taylor rule was invented by some economist called John Taylor. Professor Taylor Adward is a professor of economics at Stanford. So remember, the Federal Reserve always surprises the market when the people just wake up, the Wall Street just wake up and say, oh, the Fed has raised interest rate today. Oh, the Fed has decreased interest rate today. But you remember the Federal Reserve meets 6 to 8 times in a year. So in between meetings, we don't know what the Fed is going to do in their next meeting. Whether they're going to raise interest rate, whether they're going to decrease interest rate, or whether they're going to keep it constant. Because the Fed is not going to tell the public what it intends to do. It only will tell the public after the fact, after they've changed the interest rate. So John Taylor came up with a mathematical formula which we can use, or Wall Street, or you as an investor can use to predict what the Fed might do to interest rates in their next meeting. Okay? So this formula is based on two premises. The first premise is that John Taylor realizes that when Congress created a Federal Reserve, even though the Fed has got numerous goals it wants to achieve, Congress gave the Federal Reserve the dual mandate of price stability and output stability, meaning that the economy should be at full employment. So the goal of full employment when you're producing at some level Y bar. Let me put some whatever notation Y bar. Y bar is a level of GDP or output that the economy produces when it's at full employment, when all economy's resources have been fully engaged. But sometimes most of the time, economy is not going to produce at full employment. The economy so there are three cases. So if Y is your full employment output, so this Y stands for full employment output or GDP. That's what it is. Then let's define Y as actual output. The actual output that the economy actually end up producing. So this actual output can be below, so there are three case scenarios. The actual output can be at full employment. So when your actual output equals to the full employment value, we say that the economy is in what? Is producing at its full potential. That's what we want. The goal of the Fed is to make sure that the economy is producing close to its full potential level, full potential of full employment. But sometimes the economy can produce below full employment. If this happens, this is a definition of what? A recessionary gap. Because the economy is producing an actual output which is below its full employment value. So this is inflationary gap. Okay. Okay. Cases 2 and 3 is what the Fed is fighting. Those are evils that the Fed don't want, because we don't want the economy to be in a recession or in a recession. Recession brings high unemployment. And then when the economy is overproducing beyond full employment, we don't like it either. We don't want the economy again to overproduce beyond our full capability. That creates inflation in the economy. Okay? The ideal situation is this guy. So now that leads us to what we're going to be calling the what? This is what we call the output gap. So the output gap is deviation when we take actual GDP that the economy produces, subtract from it Y bar. That is what we're calling the what? The output gap. Because remember when we say Y was less than Y bar in the previous slide, that's a recession. When Y is Y less than Y bar, it means that the output gap is negative, because that means Y actual output is less than Y bar. If you subtract something that is what? This thing is less than this guy, you're going to get a negative number. So when the output gap is negative, that's the definition of a recession, recessionary gap. When the output gap is positive, that is the definition of an inflationary gap. That means there's inflation going to creep up in the economy because of that. But if the output gap is zero, it means the economy is at full employment. It means actual output equals to full employment. So those are the three cases we talked about. All right? So the Fed want to make sure that deviation of actual output from its full employment value is as small as possible. That's the goal of monetary policy. So there's number one. And then the second thing that Congress mandated the Fed to do, because they're not a dual mandate, so they need to work on output gap, making sure that output gap is small enough, economy is near full employment or at full employment. The other one is what we're going to be calling two. The Fed has to do what we call maintain low and stable prices. So the Fed needs to, okay, that means low inflation. And I want to make it very clear. When we say the Federal Reserve always fights inflation, the goal of the Federal Reserve is not to make inflation zero. Because when inflation is zero, that means prices don't rise at all in the economy. That's bad. If you don't let prices rise in the economy, that's a disincentive for many businesses, because businesses want some kind of modest price increase so that they can make a profit. So the goal of the Fed is to keep inflation at a low level. The target for inflation for the Fed is about 2%. So that means the Fed is going to set it. So we're going to define pi to the t as some target what? Target inflation by the Fed. And that is always about 2%. But inflation sometimes can rise above what the Fed wants it to be, above the 2% target, or it could fall below the 2% target. So we're going to define a variable, just pi without a t. We call this actual what? Actual inflation. Okay, so here's the deal. This is what we're going to be calling the inflation gap. It's just like the output gap. Inflation gap is the deviation of actual inflation from its target level, the target where the Fed has set. Okay, and there are three cases. So there are three cases of this that can happen. Case one, when actual inflation minus target inflation is zero, that's the goal of the Fed. That's where the Fed wants us to be. So the Fed is going to keep interest rate constant. They're not going to change interest rate because that's where they want it to be. Inflation, that means inflation, actual inflation, because the target inflation is at 2%, that would mean actual inflation turn out to be 2%, which is where the Fed wants it to be. So the Fed is not going to change policy. But if actual inflation, pi minus pi to the t, is greater than zero, it means inflation has risen. Actual inflation is above what? Target. That's why the difference is what? It's a positive number. It's greater than zero. In this case, the Fed is going to increase interest rates. Increase interest rate. And what interest rate does the Fed control? When you talk about increasing rate, the federal funds rate. And then the third case is when actual inflation falls below its target value, meaning that pi minus pi to the t is going to be less than zero. So in this case, the Fed would lower interest rate. Like if inflation turns out to be 1% instead of 2%, the Fed is going to lower interest rate, lower federal funds rate. Okay. So then John Taylor is going to say, if that is the case, the Fed cares about inflation gap and output gap. Because Congress gave the Fed those equal what? Dual mandate to control inflation and unemployment, right? Or output, stabilize output fluctuation. We believe that the Fed is going to set an equal weight on the output gap, that is deviation of real GDP from its full employment value. They're going to set a weight of 1/2. And the Fed also is going to set an equal weight of 1/2 to the inflation gap, which is deviation of inflation from its target. Okay? And then one thing is going to be given to us. That is, there's what we call equilibrium real federal funds rate, which we're going to define it as IFF with a subscript R. This is given. I'm going to give you the problem. Economists always estimate this to be also around what? 2%. Okay. So now, then John Taylor then came up with a formula so if I know what inflation is today, actual inflation, and I know what real GDP is today, we already know what full employment values of GDP. We know what the target for inflation is. Then John Taylor says that when you can use this formula to predict what the Fed might do to interest rate, what they're going to do to the federal funds rate when they meet in their next meeting. Okay, and that formula is going to say, I'm going to write it in full first. It's going to say the federal funds rate target, federal funds rate target is going to be equals to actual inflation plus equilibrium real federal funds rate, which I told is given, plus 1/2 times the inflation gap. Then plus 1/2 times the output gap. It's a very simple formula. So when I write them now in symbols, we know our notation for the federal funds rate target. We can write that as IFF. In short, T must equal to our actual inflation is pi, remember, plus equilibrium federal funds rate target. Remember, we say we're going to denote that as IFF. That is always going to be given in a problem. Then plus 1/2 times the inflation gap, which is given as pi minus pi t. Then plus, it's a very simple formula, 1/2 times the output gap, which is y minus y bar. This is a Taylor rule formula. Okay, which are already here. Federal funds rate target equals to inflation rate, that's actual inflation, plus equilibrium federal funds rate, plus 1/2 times inflation gap, plus 1/2 times output gap. So let me do an example. Okay, so that because an example was going to be, or example, I'm going to do 3 examples because I'm going to write this problem also in your quiz 6, allow you to practice before your final exam next week. So example 1. You can say, suppose GDP is at full employment. And actual inflation is at its target value of 2%. And then say, if the equilibrium federal funds rate is 2%. The question is, using the Taylor rule, predict what federal funds rate should the Fed set. That's right. Because you're predicting, you know all these other, okay. So we're going to use that formula. So let's summarize things here. So the solution to that problem is going to look like this. Okay. So we already been given that. So here's the solution. We have been told in the problem that GDP is at full employment. That means Y equals to Y bar. When I say GDP is at full employment, so that means the output gap, which is Y minus Y bar, is going to be 0. Because if they are Y equals to Y bar, then Y minus Y bar must be 0. Then we have also been told that actual inflation is at its target level of what? 2%. So that means the inflation gap, which is pi minus pi to the t, is going to be 0. That's right. Because actual inflation is at its target. And then we have been given that the equilibrium federal funds rate, equilibrium real federal funds rate is 2%. So then you write the formula. So the formula that, so what should the Federal Reserve target federal funds rate be? You know the formula is given as pi plus IFF or plus 1/2 pi minus pi t plus 1/2 y minus y bar. And then that means the target on inflation that the Fed must set is going to be equals to, this is given us 2% plus this has been given as 2%. And then because we have been told that actual inflation equals to this target at 2%, the inflation gap is going to be 0 plus 1/2. Because GDP is at full employment, that means y minus y bar is also 0. So according to the Taylor rule, if output is at full employment and inflation is at this target, because 1/2 times 0 is 0, 1/2 plus 0, so this is all 0. So the Fed should set a target on the federal funds rate equals to 4%, according to the Taylor rule. Very simple. So let me do another one or two more examples on this because I want you to practice. Okay. Example 2 on this. So suppose real GDP, okay, actual, so I say actual GDP falls 1 percentage point below its full employment value. What interest rate should the Fed target? Okay, so this basically says, so everything else is going to stay the same. So we're still going to assume that the IFF, the equilibrium real federal funds rate, is still 2%. We're still assuming that what? The inflation gap is still 0. Nothing has changed there. The only change is that now the output gap, when we say output falls 1 percentage point below target, it means the output gap, which is y minus y bar, is negative. This is in percentage, this is negative 1%. So when you write the formula for the Taylor rule, it's going to be IFF T equals to pi plus IFF R plus 1/2 times the inflation gap plus 1/2 times the output gap, sorry, y minus y bar. So that means the target on interest rate that the Fed should set, this is still 2%, this is still 2, this is 1/2, this is 0, and then now this is 1/2. The output gap here is now negative 1%. So that means the federal funds rate is gonna be 3.5%. That's 3.5 because this is 4, this is 0. 1/2 times negative 1, negative 1/2. Negative 1/2 plus 4 is 3.5%. So what that means, so according to the Taylor, this simple Taylor rule is that, okay, so if I say GDP had fallen by, it was 4% below target, this would be negative 4%. If I say GDP was 2% below target, you would put negative 2. But so what have we learned here? So according to the John Taylor or the Taylor rule, when what? When GDP, from what we have done, when GDP falls just 1 percentage point below its full employment value, the Fed should cut interest rate by 0.5% or what you call that's 50 basis points from 4% to 3.5%. That's right. That's what that means. Because remember when economy was at full employment and inflation was its target, with the first calculation, we found that the federal funds rate target should be at 4%. But now when output falls just 1 percentage point below target, the Fed is going to cut interest rate by what? To 3.5%. That's a 50 basis point decline in interest rate. What about if I said, what about if output had increased instead of fall? Like if it increased 1 percentage point above its full employment value, then this would be a positive number. Remember, if we are saying output has increased 1 percentage point above its full employment value, then the output gap would be positive. This would be positive 1%. So this would be positive 1/2 times positive 1. So that means the Fed would raise interest rate from 4 to 4.5% by 50 basis points. Now let's do one more. Last example there, example 3. So example 3. Okay. Suppose inflation rises 1 percentage point above the target of 2%. Okay. And assume that GDP is at full employment. GDP is back at full employment, meaning that the output gap is 0. What should be the federal funds rate target set by the Fed? So again, you summarize here. We know that. So when we say inflation rises 1 percentage point, this is a percentage sign. 1 percentage point above the target value of 2%. What that mean? That means your actual inflation is 3%, because we know the target is what? Is always 2%. So I see this 1 percentage point above. So that means the inflation gap, pi minus pi t, is going to be 1%. That's right. So we write our formula to figure out what interest rate or the federal funds target must be set by the Fed. That's going to be pi plus, this is going to be IFFR, which is we always going to assume to be 2%, plus 1/2 times the inflation gap plus 1/2 times the output gap, y minus y bar. So that means, according to the Taylor rule, this is going to be actual inflation is 3%, plus this is 2%. We live on federal funds rate. This is going to be 1, because this is 3 minus 1. And then output is at full employment, so the output gap is 0. So when you add that, so this is going to be 3 plus 2, that's 5%. 5% plus 1/2, that's 5.5%. So according to the Taylor rule, if inflation just rises, okay, so let me see here. That means, so whatever we have solved there is that so in this case, the federal funds rate target must be set at what? 5.5%. So what does that mean? So according to Taylor, or according to the Taylor rule, if inflation rises by just 1 percentage point, the Fed must raise interest rates by 1.5% from, or the 1.5% is 150 basis points, from 4% to 5.5%. And then that's the converse. That means the converse is true. What about if inflation had fallen 1 percentage point below its target value? Let's say that when it fallen 1 percentage point, that means actual inflation would be 1%. Target is at 2%. Then the Fed would decrease interest rate by 1.5. It works the opposite direction. Should decrease the federal funds rate by 1.5% from 4% to 2.5%. So what you can see here is that even though we assign equal weights to the inflation gap and to the what? To the output gap, it seems like the Federal Reserve is more aggressive in raising or decreasing interest rate when inflation increases or decreases below what? Its target. Because they're going to raise interest rate by 1.5% when inflation just increases by 1 percentage point. But when output falls by 1 percentage point, the Fed only cuts interest rate by 0.5%. So even though we have assigned equal weights, the emphasis is more on controlling inflation than it is on controlling what? Controlling unemployment. Because the output gap determines when output deviates from its full employment value, that means you could have unemployment creeping up. So that's the Taylor rule for you. Oh, so now when you look at the diagram here, so it turns out that the Taylor rule predicts what the Fed is going to do to interest rate very well. So the red line, this red trend from 1980s and so 1960s, the red line is the interest rate, the federal funds rate that is predicted by the Taylor rule. That you can use that formula to basically predict what the Fed is going to do in their meeting, let's say next month. The blue line, that's actually the actual federal funds rate that the Fed ends up setting. So look at how tight they are. So that means the red line is predicting the blue line very well. They're very tight. Sometimes they're actually the same. They move together very well. So the Taylor rule is a very good, so that's a formula that, I know some of you are going to be investors. You can use that to predict what the Fed might do to interest rates, to guide you and give you some very good investment decisions on your portfolio. That is it. That is the end of this concludes my lecture of slide 16. So make sure you watch this video and you several times, and then also you're going to study the other material of chapters 12, 13, 14, and 15, because the exam covers not only this chapter 16 that I just wrapped up, but also covers chapters 12, 13, 14, 15. I put the review sheet at Canvas if you are not in class on Monday, the final day of class. So make sure you download it there if you are not in class, but I also distributed the review sheet in class for the final exam. So I'm going to assign quiz number 7, which is the last quiz based on this chapter, because you want to practice material from this chapter 16 to be able to complete quiz 7 and also prepare for the exam, because some questions are going to come from this chapter. Anyway, it was a pleasure having you as my student this semester. It was a great ride. I really enjoyed teaching this course, and I hope to see some of you again in my other classes. For those who are graduating this next week or in 2 weeks, I just want to say congratulations. And for those who are remaining, I wish you well in your academic endeavors at Texas State, your academic journey. So thank you very much, and I'll see you guys on the day of the exam. Bye-bye.